Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. This analysis is for Friday, April 6, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Before we get into the action, before we get into all the charts and all the analysis that we're going to do, I want to make mention of the fact that I love all the comments that are coming from these videos. Keep up the comments, keep them coming. I love the interaction. I think it's healthy that we get different perspectives from different people based on what they're seeing. That's what makes a market. What makes a market is various people can look at the same chart and see completely different things, and that's healthy, and that's called price discovery because different viewpoints of the market creates price discovery. So keep the comments coming, keep the likes coming, continue to share the videos because the more people that see them, the more interaction we get, and the more we all get out of these daily analysis videos. So I appreciate the comments, keep them coming. So we all know what happened based on Friday's activity. We had another pretty healthy and large down day in the market across the board. The Dow was down 572 points. The S&P 500 was down 58. We're looking at a chart of the SPDR. That was down 2.23% or $5.92. So it was a healthy day across the board. We're going to get into various charts, various markets, and we're going to let the charts decipher what the market is telling us and what the next likely move is for these markets. So we'll start with the SPDR, and as you can see, nothing has really changed. Even though we have up days and down days in between, what we're seeing here, and this is one of those things that's discussed in detail on how to identify a bearish consolidation pattern. It's discussed in the course at Lazy E-mini Trader. This is nothing other than a bearish consolidation. We have a down move, then we have this consolidation, or I like to call it a bearish wedge pattern, and ultimately this finishes up with a continuation move to the downside. Where is this likely to end? Somewhere in the vicinity of 250, maybe even as low as 248 on the downside before a meaningful bounce that lasts for a multi-week period of time. So first off, nothing has changed in the outlook from the market. We saw the market rally on Thursday up to the 266.75 level, came up just short of that. The high was 266.64. We knew that that would be strong resistance for the market. The following day, we saw another turn down. So while the market has large swings in both directions, both on the upside and the downside, and that is inherent in a market that has turned to the bearish tone. We're in right now what I like to call a market that is agitated. When you see intraday swings to the magnitude that we've had and daily swings to the magnitude that we've had, that's an agitated market, and that's a market that's telling us that there's another large move coming. Now, when we talk about another large move coming, it could be more than one move. And here's what I mean by that. On the downside, my target is somewhere in the neighborhood of 100 S&P points or $10 in the SPDR, lower than we are now. That will be where my expectation is, and we don't just buy that area. We wait for a signal of a trend change. We wait for a market reversal at that point, and then we can hop on for the ride back upward, but only and unless we see the signals of at least a short-term bottom. We have to see a trend change signal, a market reversal, an engulfing candle, high volume, capitulation low. Well, I'll know it when I see it, but we have to wait for the signal before we can just hop on board, because if you hop on board and the market continues lower, you can get hurt. So we wait for a low to be put in, or what at least looks like a low, and then we have something to trade against. We have a defined low that we know that if the market breaks that low, then the market's likely going lower, and we have to look lower to hop on board. So we have to have a defined low before we actually risk our capital. As an example, here was a defined low. This is a long tail candle, high volume capitulation low. That's something like we're looking for. They don't all look the same. They don't all act the same, but we'll know it when we see it, when it occurs. What the important thing right now is we haven't seen that type or any type of low or any type of market activity that tells us a low was put in. A lot of the analysts on TV are trying to say that this 200 period moving average continues to hold. We continue to bounce off this 200, and that's why you're seeing buyers emerge each and every time we come to or even get below the 200 period moving average. But what we know from the teachings in the Lazy E-mini Trader course is that the more times a market either hovers above or below an important level, consolidates above or below an important level, it diminishes the importance of that level, and that price level, in this case, the 200 period moving average, is more likely to give way than even it was before. Each and every day that passes by that we continue to hover right above and pierce through and spike back above the 200 period moving average, we're lessening the importance of that 200 period moving average. So we have to be very, very careful assuming that this 200 period moving average is going to continue to hold. Now, here's another thing I want to make mention of, because it's very important that we realize that the market is designed to trick, trap, and fool as many market participants as it can. And the reason I bring that up is because I've seen this time and time again where leading into Monday, Sunday night, the futures open up. And the futures can open up, as we know, up or down. But let's just assume for a second, in a hypothetical scenario, the futures open up. They open up 5 or 10 points. And they open up and continue going higher. And by the time we get to Monday morning, the futures are up considerably. Monday morning's market opens, the short covering starts, panic buying I like to call it, and next scene shows the market is in recovery mode and we're considerably higher than where we finished Friday's close. The reason I bring this up is because we've seen this time and time again. Look at this market. We go down, we go up. We go down, we go up. We go down, we go up. The swings are large in both directions. We went down on Friday, so I'm not suggesting we're going to see an up market on Monday, and I'm not suggesting we're going to see a down market on Monday. What I am saying is that the likely next larger move and the completion of this pattern is to the downside. It doesn't mean we can't have another strong up move. Can we get back to the 266.75 or even into these moving averages before we take another trapdoor ride down to lows? Absolutely. That's one way the market is intent on tricking, trapping, and fooling as many traders, investors, market participants as possible. We don't know that that's going to happen, but what I'm saying is if we see that begin to develop, it doesn't necessarily mean that the market has completed what my expectations are on the downside. So if the market goes up on Monday and Tuesday, that's okay. It may present and likely will present another selling opportunity for another leg down in this market. I am and remain in the camp that there is one more leg down on this move coming before any kind of meaningful multi-week rally in this market. Here's a chart of the IWM, my favorite market leading indicator. It's the Russell 2000 index, and the chart looks very similar to the spider chart. We're below the moving averages. We're hovering above. We've only pierced through or spiked through one time the 200 period moving average. And it is a little interesting that we saw less of a decline in a percentage basis than we saw from the S&P 500 on Friday. So I'm noting that, I'm aware of that, and there is a slight divergence that we certainly have to be aware of. It was a big down day, down 2% in an index like this is a big down day, $3, and we are certainly in a weak technical position in the IWM, but I do have to be aware that as it relates to, and even by a slight amount, but that is meaningful to me, even a slight divergence or relative strength compared to the SPY or the S&P 500 has to be noted. It's a puzzle piece. I put it on the table. But in and of itself, it's nothing we can make a solid decision on. We just have to make sure that we're aware of it. I want to run through some other indexes tonight just to take a look at the patterns that exist on these charts and see if we see anything different, anything that strikes a chord that we should be aware of. The first one we're going to take a look at, which we do look at quite frequently, is the volatility index, or the VIX. And what you'll see in the VIX is the opposite of the SPY pattern. It's a bullish pattern. It's intact. The bullish pattern won't be broken until and unless we close below a certain price level. Traders that have taken my course at Lazy E Mini Trader know exactly where this pattern breaks apart. Right now it's intact. We're above the moving averages. What this chart is telling us is the mirror image of what the SPY is telling us. This chart is telling us that it wants to make another move higher. We have an up move off the lows. We have bullish consolidation remaining above the moving averages. In large part, this pattern generally finished with another move to the upside. So basically, it's confirmation of what we're looking at on the spider chart. NASDAQ Composite. So here we are below the 20, 50, and 100 period moving average. We have not yet touched, we have not yet spiked through the 200 period moving average. I find it a little bit interesting that other indexes have traded in and through the 200 period moving average, but the NASDAQ has yet to come down and touch the daily chart 200 period moving average. Is that bullish behavior, or have we just not got there yet? It's interesting. I don't have that answer. It doesn't look like bullish behavior to me. It looks like this market is in a weak position below the 100, 20, and 50 period moving average, and we are making a bearish consolidation pattern, although it's not quite the same. It's not as tight, certainly, as the bullish pattern we see in the VIX, and it's not quite the same as the spider pattern, although it is a bearish consolidation pattern. I'll just call this one sloppy. If we get a smash and grab in the market and we go to the downside, whether or not we go up first, but ultimately, if we have a real smash and grab to the downside, where can the NASDAQ Composite go? The NASDAQ Composite, in my opinion, can go down to 65, maybe even 6,400 in this index. That puts us right about here. You have a double low or a double bottom down in this area here. Okay, I don't expect that to hold. Why? Because we've consolidated above the 200, which is really close to this double bottom here. And if we get a smash and grab, I think we come down to about 65, 6,400 in the NASDAQ Composite. Here's your transports. We go over this each and every night, and you can see in the transports, again, this was a very, very well-defined bearish pattern that's still developing. Again, we're above the 200 period moving average, made an attempt at it Friday, did not hit the 200. We came very close and we bounced off that and we closed back above the low from the 2nd of April. Is that meaningful? I'm not so sure it's meaningful. What I look at is the longer term pattern, and what I see in this longer term pattern is a down move, and I see this bearish wedge pattern, bear flag pattern, whatever you want to call it, that will generally finish with another continuation move to the downside. We've got a line down here at 96.50. I think that's where we're headed. Maybe it's 9,600. Maybe it's 9,675. This is the general zone. That's what this pattern is telling us. My expectation is this pattern plays out to the downside. Keep in mind, and I keep going over this because I don't want anybody to get the wrong impression, we can certainly have another whipsaw in this market and go back up another few hundred points in the transports as we can in other markets, which doesn't do any damage to this bearish pattern whatsoever. As long as we really stay below these moving averages on a daily chart closing basis, right? We can spike above them intraday, but as long as we remain closing below these moving averages, We can have one heck of a whipsaw in this market and still do no damage whatsoever to this bearish pattern. So I just want traders to be aware that there is an element where the market will trick, trap, and fool as many participants as possible, try and suck more people into the long side, and then pull the rug out again, just like they've done over and over and over again. When you take a look at this pattern, and we see the same thing on all the charts, red candle, green, red, indecision, which is a doji, green, red, green, 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 big red. Okay, so you never know what's coming Monday, but what I do know is that this will ultimately finish to the downside under normal market conditions. That's what the percentages are telling us. That's what the probabilities are telling us. That's what the chart pattern is telling us. Until and unless something changes, and what would have to change is we would have to have one heck of a rally, and ultimately it'd have to get above the moving averages and really above these pivots in order to take the downside totally off the table in the short run. We'd really have to get above 10,800 to really say something else is going on in this market and we're temporarily taking the downside off the table. Until and unless that happens, this is a bearish pattern. We never look at the Dow. We might as well look at the Dow today. The Dow Jones Industrial Average was down healthily. Healthily? That's not a word. It was down a healthy amount, 572 points. What is this? The same bearish pattern we're looking at over and over and over again. And when you see the same thing over and over again, while we can have an up day or two, this will generally play out to the downside. Sounds like a broken record, but when you look at markets over and over and over again, and they all point to the same thing, it's generally what's going to happen in the longer run. Broker-dealer index, XBD. Again, bearish pattern. We closed below the 50-period moving average, even though the day before we were above it into the 20. And you can see this is a pretty well-defined bearish pattern until and unless we get above the moving averages, close above this gap, for example, then this market is trending to the downside. Now, we haven't got anywhere close to the 200-period moving average in the broker-dealers. We're hovering above the 100-period moving average. The longer we hover above the 100, the more likely it is to break. I don't expect the 100-period moving average to hold in the broker-dealers, so it's just a matter of time when this is going to break. In my mind, it's really not an if. XLF, which is another financial-related indice or financial-related exchange-traded fund. And again, same pattern we see over and over and over again. This one is hovering above the 200-period moving average, and therefore our expectation is this 200 will not hold and it will break to the downside. When it breaks to the downside, where are we likely to go in the financials? There's a lot of support in the 23 area. It's quite a ways down from where we are. Nothing goes in a straight line, but if we get a smash and grab in the market, and the market really does sell hard, and the financials sell hard, then my expectation is that we're going to see a ton of support come in around the 23 area in the XLF. So write that one down. Now next, we'll take a look at the Shanghai Index. Why? We never look at this, and there's a reason, because nobody's really trading the Shanghai Index. However, at least nobody here. If you're in China and you're in Shanghai, you obviously trade the Shanghai Index. But here's the thing. So in the news, we've gotten a ton of information back and forth about the trade wars. I'm aware of all the news. I don't talk about the news a lot because I don't care what the news is. I really just care about analyzing the charts. But I certainly am aware of what the news items are. And so obviously, each and every time the market goes down, the media pins it on the trade wars. There's a tweet from Trump. There's a new trade war coming. There's a retaliation from China. I'm understanding of all that information. So I do want to bring up the Shanghai Index and see what the Shanghai is telling us. And is it telling us something where the market can give us an indication of what the next likely move is in the Shanghai? Is it diverging from the U.S. markets, or is it following suit? And what you can see here is we've had a pretty big down move in the Shanghai, right? And then we have the bearish consolidation like we have in basically all the markets that we've looked at thus far. They don't all look identically the same, but they all look very similar to each other. And in the Shanghai, it's the same routine. A big down move, a bearish wedge pattern, a bearish flag pattern. What's this going to do? It's generally going to finish to the downside. So this is telling us that there may be something to the trade wars. There may be something that's impactful to both markets from an economic perspective, the U.S. markets and also the Chinese markets. So what I would say is that the Shanghai Index is confirming what we're seeing in the U.S. markets. And you want to see something cool? And this is something that I make it a very strong point to teach in my course at Lazy E-mini Trader, that all markets act and react the same way. All charts act and react the same way. It doesn't matter whether we're on a 10-minute chart, hourly, daily, weekly, or monthly, or anything in between. They all act and react the same way. Now I want to show you something. I want to go to a longer time frame in the Shanghai Index, and you'll recognize this pattern that we've looked at in the bond market before. In fact, before we do that, let's go take a look at the bond market, because I've shown this chart many, many times, and from a longer term perspective, what the bond market was telling us. So I'm going to go to the monthly chart, and if you remember, and we haven't looked at the long-term bond market chart in a while, but if you remember, we had this down move, and then we had this bearish wedge pattern, and we know that markets like to test former breakdown and former breakout areas. Well, the market broke down right here, and the market tried to wedge its way back to the top end of the last red candle, the top of the breakdown candle. And we never quite got to the top, but as you can see, the market broke down from that area and we're significantly lower, and we already tested the lows. Now, this market will go lower over time, but that's not the point. Just focus on this area right here. I'll draw it one more time. So we have the top of this last breakdown candle, and the market tried to edge or wedge its way back to test the top of this breakdown candle, didn't quite get there, and then was rejected. So this is a bearish wedge pattern. Now let's go back over to the Shanghai on the monthly chart, and you'll see what this is. Now look, the last breakdown candle, top of it is right here. What did we do? We broke down, and the market edged or wedged all the way back to test the top of that breakdown candle. It was rejected at the top of that breakdown candle, and now we're headed lower. So when you look at the long-term chart, and these things take a long time. This is back from the beginning of 2016. Okay, so this is a long time to develop. This is a monthly chart. So as you can see, are we starting another downtrend in the Shanghai that's going to come back and retest or break down or break below the lows that were made on this breakdown candle? Well, likely story is we're going to at least test the lows. Again, this is a long-term chart, so it's not going to go immediately there, and it's not going to go in a straight line. We'll have ups and downs month by month, but ultimately we should come back to test this double bottom area that comes in at about 363, give or take. You see, folks, I'm not making this stuff up. All charts act and react the same way. It makes no difference whether we're looking at a Shanghai index, we're looking at the XLF, we're looking at the Dow, the NASDAQ, the S&P, or Apple, Google, Amazon, Netflix. It makes no difference. All charts act and react the same way. And that's why traders that have taken the course at Lazy E-mini Trader, they can trade the E-mini futures contracts, they can trade the NASDAQ, they can trade any stock under the sun, they can trade any market, any index, anywhere around the world. Everything in that course, all the information can be applied to any market, any chart whatsoever. All right, let's switch over to the gold market. I think I spent ample time on markets around the horn, even around the globe, and I think you should have a pretty good idea of what we're looking at. Just be aware that markets will have big swings in both directions in environments like this. In the gold market, again, we don't have a clear picture one way or the other. The longer term, from the weekly chart, we still have a bullish pattern that should play out to the upside. And when you look at the daily, you can see it here, and then we'll look at the weekly in a second. But this is essentially a bullish pattern that will ultimately play out to the upside as long as it doesn't fail. If it fails, it fails, but that's what generally will happen out of this pattern. When you look at the weekly chart, you see it better defined on the weekly chart. Here's the same move. It's an up move, and here's basically a bullish pullback pattern, a bull flag pattern, a bullish wedge pattern. I like to call them different things. It really doesn't matter what you call it. What matters is, can you identify it? And this will generally play out to the upside. So it's just a matter of time on when and if it's going to play out to the upside, but it's giving us some havoc. When we go to the daily chart, it's extremely sloppy. It's very difficult to deploy any capital in the gold market with these type of swings. To go from the low 1300s to 1350 or 60 or beyond and then back down, it's very difficult to hold on for a move to the higher side. Until and unless we get some clarity in the gold market, we're just going to keep looking at it. We'll keep discussing it, but I don't have a trade here in the gold market with its sloppiness that we've seen. So we'll just keep watching it and we'll move it along. Just keeping in mind that at some point in time, we should break to the upside. Crude oil. Now, look at this. Crude oil got whacked, and look where we came to. Look where we stopped short. We had this trend line drawn in there a few days before, and it stopped short exactly on this trend line, right around, slightly below, but right around that 62.13. And I said, if that number comes in corresponding with this trend line, that should provide at least short-term support for this market. The question is, if we break below this trend line, then it's going to be pretty obvious what happens. The next line of defense on the downside is going to be right around north of $60, 60, 60, 50, in that neighborhood. Then this double bottom comes into play down at 58. So if this trend line breaks, meaning if we close a day, if we close a daily chart below, or a candle on the daily chart below this trend line, then you'll have some support at the 100 period moving average. But the next logical area of major support is down here right around 60 and then right around 58. And that will take temporarily, at minimum, of some of the upside that we've been discussing off the table. We had a run to the upside. We failed. Now we'll see. It's make it or break it time, because we've basically had, and I'm just eyeballing it here, looks to be about a 50% retracement. Well, maybe it's short of 50. It's probably a 382. Now, I was right the first time. It's about a 50% retracement when you take into consideration this pivot low and this pivot high. We've come back to test about 50%. It's make it or break it. Is the market going to react off the 50% and have another move higher, or are we going to bust through and test some of the lower levels? We'll see what happens on Monday and beyond. But no surprise that we did find support at this trend line. This is why we use trend lines. It's not me that draws in the trend line. It's the market that draws in the trend line. The market is respecting its own trend line, not my trend line. Very important to recognize that. It's not us that determines support and resistance for markets. The market will determine. It's up to us to interpret what the market is trying to tell us. And with that, folks, it's everything I wanted to and intended to discuss today. So I'm going to leave it here. I'm going to give it a wrap. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.